Good morning, everybody. Welcome back to Schwab Coaching for the Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from a beautiful Denver, Colorado today. I am running solo, of course, on Thursday, but I am still pleased to be joined in the chat by my friend and fellow coach, Barb Armstrong, this morning. Please say hey to Barb. She's going to get to questions, comments, and details you guys put in the chat that I'm unable to get to, but I'm hopeful to hear from you all today during the discussion and try to bring in your questions and comments to that discussion. On a solo day, it certainly makes it a little bit easier on me. So love to have that from all of you. Feel free to post in there for the duration of the show. Additionally, follow Barb and me on X. Barb is Barb Armstrong CS, and I can be found Kevin Horner CS there on X. We both try to post for you throughout the week. My approach is frequently posting charts. I'm a big fan of looking at as many charts as I can, things that pop up on my watch list that look interesting or notable. I try to bring those to you all there on X. So if you're looking for another follow there, Barb and I would really appreciate that, everybody. Okay, we are going to do a slight shift in how we normally handle today, in the sense that we're going to try and break away from just overall market analysis. We're going to talk about a few individual positions. We're also going to look at the scan tool here, bring in, as requested by a few of you, a Horner rule scan, which I will define for you all, and we'll make that available, share that with you here in the chat as well as in the notes afterwards. So for those of you following in the archive, make sure you make note of the fact that you will have a script in the notes that you can access and bring into your Thinkorswim desktop application. All right, let's cover all our disclosures and then we'll get into the fun stuff. First, remember that our discussion here is exclusively informational and educational. We do not make recommendations nor endorsements for a particular strategy or approach to trading. Remember, while we took technical analysis here quite a bit, we do so, again, from that educational side of things. We want to provide ideas and insights that traders use from the concepts of technical analysis, but it's important to remember that technical analysis is nothing more than a piece of the puzzle in your decision making. We think you can utilize a number of pieces together to formulate those decisions. We discourage you from utilizing only technical analysis in basing your decisions. All right, and again, our agenda will essentially be the same because I am going to start with the major indices, but the latter portion of the show here, the first 15 minutes, we'll start with those broad market looks, and then we're going to get into, like I said, some individual stocks in the news. I know we had NVIDIA reporting after the bell yesterday. We had jobless claims this morning, so I'm going to try and sprinkle all of that over the discussion as we work through things, everybody. So let's take a look at the S&P here today. One of the main questions that I've been fielding over the last 3, 4, 5 sessions or days in the last week here is really about the breakdown that we have made, the pullback from the 61.47 high, giving us a test of that 5,900 level, which resides right here approximately. And the question I fielded online on Twitter, X, as well as here in YouTube has been, how could we have maybe prepared for this move? This was a significant sell day. We don't get a whole lot of negative 1.5% days, 2% days in the SPX. They do periodically come, but when they happen, what is our plan? What is our process? How do we I can't say predict because I have to remind you all, technical analysis isn't really a predictive tool. It really is hindsight viewing, right? And one of the things we talk about all the time, one of these general market axioms, if you will, is the idea that the market doesn't repeat itself, but it often will rhyme. What do we mean by that? Well, I didn't really understand that concept when I first got started in utilizing technical analysis back in the late 90s. The truth is, I needed a 20 to 25 year history to really grasp what they're talking about when you hear that thought. The idea is things aren't always going to be the same, but the cycles of the market are often the same. You can find some charts that look very similar in windows of, extreme optimism like we had in 98, 99 and into 2000, for example. And you can see some of those levels looking similar in terms of chart and price action. But I always discourage you from thinking that while what you see on a chart resembles something you've seen before, don't be misled that it's got to happen that same way, right? So as it related to Friday, the thing that I wanted to talk about was just the significance of the candle, the size of the candle, and also the understanding that we as traders, we need to know the levels where we will take action. I've said this on many occasions, everybody. We individually, we're going to be wrong about the levels at which the market chooses to cease the selling or stop the rallies. The point we need to take in is how we choose to manage those individual positions. That's on us individually. Some of us are holding those positions, managing the weakness because we evaluated, as an example only, this is not saying how I did this, but when you look at that 5,900 level, it does look even prior to this day. So if we just went back in time here and we were looking at it like as though we hadn't gotten to last Friday yet, right? And you said, well, Kevin, I don't think we're going to see 5,900, but where would I feel like it's getting more opportunistic, where it is more likely to happen than not? Well, when you start moving through the 20-day, now that becomes a little bit more likely. If you move through the 50-day, even greater likelihood of visiting the last level of horizontal support at 5,900, right? So as you move through the chart, on an intraday basis, a one-day basis, you'd be perfectly fine to say, well, I was basing my decisions on the 50-day in purple. We retreated and held it. So I have every reason to hope and to believe that if we can hold on to the 50-day, I don't need to exit any portions of any SPX positions, for example. But the very next day, we got that close below the 50-day moving average. And now traders might be feeling a little bit further defensive, right? So again, I'm never going to know one definitively or not, one way or the other, which direction the market is necessarily going to go. But what I hope we as traders are doing is saying, well, if the market does this, well, then this is how I'm going to act because it's going to make me more comfortable with my dollars devoted to the market, my dollars at risk in the marketplace. Okay. And so day one below the 50-day, for some of you, that might not have been a sufficient reason to move on. Maybe it was day two and you said, okay, we're 2 days below the 50-day. I'm not ready to move on because I haven't gotten to day three yet, validating a true breakout. Well, here's day three below the 50-day moving average with a test at the 50-day moving average. And then we go forward one more day. And where are we? And here we reside today, 59.89, still balancing it out, still trying to figure it out, right? Are we validating the low at 5,900? And can we get back to 61.50 approximately? From here, it's still, as of yet, on the daily chart, unclear, right? But what is clear now, everybody? I think what we could say is that under 5,900, traders of the SPX are going to likely lighten up their longs and get a little bit more defensive because it could mean a 200-point SPX move to about the 200-day moving average, which resides just over 5,700. Okay, so my hope today is that the real takeaway is not to believe that we are capable of always knowing what the market is going to do next, but rather building in our if-then statements across the board, right? And sometimes, everybody, this is tied to just your true cost, or your comfort with your risk factors, the amount of money you have on the table. And a lot of the time, you can manage your concern about what the market is doing by simply having a proper amount of money on the table, such that you could manage a slippage like we got on Friday, a fall through the 50-day moving average down to horizontal support. If you can't manage those details, those swings are too great, and you feel those in your gut, that's a pretty decent red flag for you that you might be over investing or putting too many dollars on the table. Okay, so hopefully that was a kind of just a a little level setting for us as it relates to thought process, emotions, etc. If we take our S&P 500 and try to get a little more granular, we can look at a 5-minute, 5-day chart, and then we can talk about something like these pivot points, which many traders will use on a short-term basis for a little bit of heads up. The fact that we've opened today above our pivot point is a positive for the day. A negative for the day would be if we traded below it and couldn't recapture it today. Nothing to suggest that we have to. We might retreat to it, hold it, look at it as a test of short-term support. That's possible, but we're enthused by the fact that we opened above the pivot today, as opposed to opening with a gap move below it. Let me just remind you all, the pivot point, the purple line, is just the equilibrium trade valuation from yesterday. The pivots incorporate the prior day price action, the open, the high, the low, the close. Average those together. That gives you the equilibrium price, 59.66, around which we would expect price action to trade in the SPX today. So can you utilize the intraday window to help you maybe get a clearer picture? Sure. But I'll remind you all, shorter term, the less reliable these patterns, these trends become. So just be aware that we, if we go into these 5-minute bars, 1-hour bars, etc., then we do run the risk of making decisions in the short term that may not be held given a closing valuation, for example. And this is one of the reasons we often say closes below this level of support become problematic, not necessarily trades on an intraday basis through that, right? Because if you were looking at the low in here, for example, the fact that we bought up that low on Tuesday morning and have used it to rally, have since can basically been above the close here over the last couple of days. We've been trying to figure it all out. The fact is, we held that ledge, right? We got down to that 5,900 and held it. And that intraday price action often is not necessarily, I should say, the spot where traders will base their decisions. Commonly, the traders will look for closing valuations there. As far as adding those pivots, thanks for asking, Alexis. We can do that via the beaker right up here, most easily at least. So we'll apply that here. And of course, I've already got it added, but if you just start typing in pivot, there you go. There they are right here. And then, of course, don't forget, once added, you can use the gear icon to play with your customizations, your plots. Here, by default, it defaults to auto, and that's going to make these lines appear as though they are just dots on your screen. So if you change it to numerical, it'll give you a better visual, more of a standard solid line. But make sure you move through and adjust your parameters, your style of your line, the weighting and colors, etc. That's one way you can give thought to that, everybody. Okay, so there's your SPX discussion. Really, not a lot to say that we need to be watching here outside of the 5,900 level, right? If we can recapture the 50-day, then maybe we've got some continuation in here. But in the short run, that's our first level above which we need to trade in the SPX. Let's move over to the NDX here. A little bit of a breakdown. We have noted a couple of key components. We made this higher high in price. We've made a lower high in the RSI. So we've got a divergent high that has played out bearishly, pulled us back to an area of support. Interestingly enough, these levels are also coincident with the levels and the move that we saw in the SPX. So there's been some consistency amongst those. But that level here at around 20,950 appears pretty well set as support, since we've tested it once right here, a second time here, and a third time here. So validated support with the number of tests, and this could look like a potential for further breakdown. Now, don't know, right? We can talk all we want about the visual of a pattern. Rita's mentioning the potential for a bear flag in the SPX. Well, much like that, you can see something similar here, right? We had a big move to the downside, and now we've gone sideways a little bit, and it kind of looks the same, doesn't it? So we only call them a bear flag in the midst of forming it. But if it were a legitimate bear flag, then we would need to break the flag to the downside. Trading under 21,000 would be the indication of that potentially, and then we'd be looking for the potential move of the height of the flagpole from the breakdown level. And that means that could be a pretty, sorry about that. That could be a pretty significant move if we were to, do it like that. But remember that just because you put a couple of lines on the chart, we make a measured move calculation, those are not guarantees to be achieved, of course. That's just a way that traders will look to try and set some price levels for themselves. But yeah, it's a potential bear flag. What do we need to see? Well, we certainly could trade above it at 21,350, 21,360, and we could even trade above it and into the maybe the 20-day moving average and could still get rejected. So don't believe that just breaking the flag to the upside means all clear. That's not necessarily the case. I don't want to give that impression. So yeah, we're waiting here. A little bit of wait and see. Now we are day 4 below the 50-day moving average on the NDX. That might be getting a little bit uncomfortable for some of us as trend traders. So just kind of keep that stuff in mind, everybody. All right, let me lift my draw set here. Let's check out what's going on in the Russell. We're getting a little red here off 0.2%. Well, I got so much time on this chart. Let's go to a 1 year. And all right, so here we've been selling down. Pretty healthy candle move there with last Friday on the heels of this whole discussion about the potential softening of the market, softening of the economy. In fact, jobless claims came out this morning with a higher than expected total, 242,000 for the seasonally adjusted number. That's up 22,000 from the revised level of last week. So that kind of gives a little bit of a hint of the softening of the economy. And of course, that softening doesn't make the overall market feel great by any means. I mean, obviously the market has a habit of being forward looking, of course. So while we are in the midst of watching the market do what it does, what's happening on a day-to-day basis when you go to your grocer, for example, or you fill fuel, these are not necessarily reflections of what you see in the stock market, because the market commonly thinks out 6 to 9, maybe even 12 months into the future. So if we start talking about things like recessionary opportunities and that kind of struggle that we could be in, then that's going to start to play out in the form of price action here. Now, what we don't mind at this point is a well-established level of support, but you can see again, 1, 2, 3, today is day 4, and if we incorporate here, day 5 below the 200-day moving average. So this is getting a little uncomfortable for small caps. And while we would be happy with any kind of bounce we get, bounces could be short-lived, because we've got a short-term downtrend in place. We've got the confluence of the 50-day in purple and the 20-day moving average in orange all coming together at the same ledge, right around 2260. So maybe we rally, we get a bounce back, a relief rally, some traders would call that, into resistance where that rally just loses steam. And if we make another lower low in this downtrend, well, then our risk becomes that we have a better chance of making, I said a lower low, I meant to say a lower high, excuse me. Lower high with any bounce into the trend line, any bounce into the resistance zone here with the moving averages. But if we make and fail at that lower high, well, now we are at greater risk for making a lower low, continuing the downtrend that's been working since late November. That's what we want to see change. We want to trade above the red line, above the moving averages. That would give us a bit more confidence. Okay, so that's where we stand on the major indices at this point, everybody. We are healthy for the day at this point, kind of flat. And, again, flat is okay. Yesterday, when we got the report on NVIDIA, we had a pretty decent indication that there was going to be some volatility. Well, the volatility really didn't come into play here. I mean, the expectation for a move in NVIDIA was about $12 to $13, one direction or the other, and we really didn't get it. So yesterday's move, in terms of the price action today, the traders that benefited from the NVIDIA detail are those who chose to sell premium in the form of maybe options, for example, because you have a high implied volatility right ahead of a major earnings report on a major company like NVIDIA. You will often see traders looking to capitalize on that. And so selling premium as opposed to buying options is commonly employed around earnings windows for traders who may not wish to quite speculate as much, right? They want to try and put themselves into trades that could work for for a scenario where there's not going to be the volatility that may be expected by so many traders. And really, we have had very, very tight swing here. Now, in the aftermarket, there was a pretty good range, 125 to 136. We actually got that almost $12 move one way or the other. But as you can see, we've not really broken anything out of that high or that low at this point, right? So today, here we are dancing now beneath the pivot point on NVIDIA. So maybe getting a little bit less comfortable now with where we reside today. But the move on an overnight basis and in the after hours was very limited in scope. Let me give you a couple of headlines on NVIDIA. One of them is actually a downgrade here today. Summit Insights downgraded NVIDIA to hold from buy. It says the stock should continue to outperform consensus expectation based on current market demand, supply chain checks, and the leadership of the company. But it does state here at these levels, the risk reward on the stock is no longer favorable due to the persistent high whisper numbers, the rumor of entry into the PC client market, according to analysts here at Summit. So they're basically suggesting that from a fundamental standpoint, they don't appreciate the risk versus reward at this point. We talk risk reward frequently, as you all know, relative to price action, putting you in opportunities for trades where your downside is risking $1, your upside is trying to make $3. We talk about that all the time. Well, they're going to talk about it from a fundamental balance sheet viewpoint, and can the price of the stock be maintained given the underlying fundamental criteria, right? That's ultimately what they're going to be looking for. Summit does not think that that's the case. So that's the reasoning for the downgrade. Now, outside of that, I'll note I don't have a headline detailing any upgrades on NVIDIA. I have a few price target changes according to a few different locations. JP Morgan reiterates their overweight on NVIDIA, and they put a target at 170 after the results. So that's not terrible given where we're trading here at 130 or so. A $40 improvement from this point would be something in the level of about 30% upside, right? Again, no guarantee of that, but that's the expectation from JP Morgan. Bank of America raised their price target on NVIDIA to 200. That had previously been at 190. They maintain a buy rating on the shares. Morgan Stanley raised the target to 162 from 152, maintains overweighting, and Citigroup maintains a buy rating, new price target at 163 on NVIDIA there. So some significant updates to price targets and whatnot, but not necessarily significant shift in price action. As you can see, as it relates to NVIDIA here, everybody, that 200-day moving average remains pretty important. Today's candle is certainly uninspiring. We don't like to see, like a bear engulfer like this, where we traded upward through yesterday's high and couldn't hold and have rolled over. What we want to see is this candle kind of unfill, right? We want to see price action carrying us back upward with bulls taking over here. That has not yet happened. And that's because, of course, we're watching the selling as we speak, right? Selling is getting a little bit less comfortable here. So the hope maybe is we get a bounce in NVIDIA pretty quick. But once more, I say things like hope. One thing we try not to bring into our discussions as traders is hope. We try not to make decisions based on hope. We try to make our decisions based on some legitimate ideas and concepts. Hope is not one of them. Try and put ourselves in positions of comfort all the time, wherever that may be. So good reminder there, I hope. Now, let's see. We also heard from a couple more. Let's see if I've got any details here on Snowflake. Yeah, I do. So we're going to bring Snowflake in. They announced after the bell. Now, this one is having a bit of a different reaction, as you can see, a bit more volatile. We're up about 7.5%. We're up a bit higher, though. We opened at 187. So this thing was up fantastically, better than 10% off the jump. Getting a little bit of profit taking off the open here. News relative to their report. I have, again, no real shifts to ratings necessarily, but Barclays raising their target to 203 from 190. JP Morgan analysts raising the target on Snowflake to 210 from 185, maintaining overweight rating on them as well. So, from a trade standpoint, everybody, the thing that stands out for so many, I would imagine, is this approximate, level of various support we've seen in here. Yeah, we could talk about it from this tagged low we made just a couple of days ago. Some traders would prefer to use the ultimate low of the gap since the gap up. Some traders even still would say, you know what, why not consider using the low of today, whatever that ends up being, meaning that maybe right now is not the time for a trader to take a snow position, but rather let today's action play out and see if we get any continuation to today's move tomorrow, or if today's move fades further, to kind of give an indication as to whether you can set entrance and exit strategy against the 50-day moving average, or if you still believe in it and it trades as low as the ledge we just bounced from, maybe the 159 area is an area where traders might be a little bit more comfortable. It also could be said that this is a bit of a difficult pattern. So I know that many of you are frequently looking for magic bullet theories. Hey, Kev, is there some way that you can help me to avoid making a mistake or something that's going to work every time? And I'm just going to tell you, unfortunately, no. There is no real trading technical study or anything that works 100% of the time. None of them do. And really, what I've found in my experience has just been the easiest way to manage your patterns and charts is to ensure you're not over investing in any one single position. That's the hardest thing to get through, I believe, because simply put, you know what? If you overinvest, at least in my experience, when I overinvest, when I have too much confidence in an individual stock, my goodness, is that when I get beaten up. And it's inevitable. It feels I talk myself into it even still. And only when I'm staring at the worst move possible do I realize, man, if you just would have stuck to your process, you wouldn't be feeling like this. This wouldn't be something you have to deal with. And often it's as simple as that. So try not to put yourself in opportunities to frustrate yourself. Might be a good way to look at it. All right, another one we're going to look at real quickly here is Supermicro, SMCI. They but they finally filed that 10K. Now, what's intriguing to me is they filed it and they got a little bit enthusiastic with yesterday's move. And then the market said, well, that's all well and good, but, I'm still uncomfortable. And you can see we got thrown back below my support line today, not exactly having a fantastic percentage move, off 11% here today, everybody. So that's rough. Now, they did say that the matter with the SEC is now closed in their regulatory filing. They stated on February 25th, they received a letter of notification, from the NASDAQ indicating that the company now complies with NASDAQ listing rules. That requires that they timely file their reports with the SEC, of course, and the matter is now closed. But that doesn't mean necessarily that everything is perfect and hunky-dory, but it is an improvement for the security. Now, you're probably witnessing a little bit, from the price action standpoint, a little bit of back and forth in here, some profit taking, speculators who expected this to play out the way that it has, are potentially unwinding positions. The reason I'm bringing this up right here, everyone, is that this move is tied exclusively to the narrative and the story alongside the SEC, the lack of them reporting properly, right? So buyers back here are ramping up, volume ramping up. All of this is likely tied to the story. That means that if it's tied to this story and this is now no longer a story, there may need to be a little bit of an unwind here. Okay, so let's monitor. If we're a short-term trader monitoring likely the 20-day moving average in orange, I think some traders would tell you there's a couple of notable detail here. One, you've got horizontal support with the prior bull flag that from which we rallied aggressively, right? We moved through 43, got all the way up to 66, a 50% pop in 3 days. Well, you're going to get some back and fill on that, right? And that's what we're dealing with now. The hope here is that the 20-day maintains, I say the hope of the trend for bulls participating at this point. They want to see the 20-day provide support. New traders who are now saying things like, well, this is now not overhanging the company, right? Maybe now you can start paying attention to the stuff that matters from a standpoint of doing business. Are they still selling enough, right? Are they generating their revenues, et cetera? That's maybe as simple as looking at the recent short-term details, the short-term moving average. That's why that 20-day might be pertinent. It also coincides with that long-range downtrend here as well. So I made that a 2-year chart. You'll see the significance of that. That's not small, right? And sometimes it's as simple as technical analysis 101 stuff. We broke a downtrend line, we rallied, and now we're thrown back to the downtrend line for a test. That is 101 technical analysis. Doesn't mean it has to hold here, of course, right? But if it holds, if you hold the 20-day, traders could say, well, you know what? I could take a position here and only sell if we closed below the 20-day. Maybe it's 1 day. Some traders would say, no, I need 2 days closing below the 20-day. That'll kick me out. Other traders would say, no, I need that 3rd day, Kevin. I want that Horner rule process that might keep me in or out of a position. I'm going to use confirmation, right? And that's a key component for many traders, is allowing price action to confirm itself by, in some cases, closing below, as we're talking about SMCI in particular. If this were to continue weakness, some traders would say a close below the 20-day would be the indication of that. Some additional traders would say, no, 2 days or 3 in a row, that tells me there's a breakdown below the 20-day, and that's validated. So another way to maybe give thought to it. Now, today, I did mention the Horner rule here, and it's a perfect opportunity to bring the discussion around what the Horner rule is. Let me give you all a little bit of clarity on that, a little more clarity perhaps. And then I'm going to show you that there's a scan that I've built with the help of a follower and fellow chartist here on Twitter, X that is, came up with this idea of how to build it, and gave me some script details, and then I went ahead and customized it a little bit further. So Christopher, I want to thank you for that. Let's go ahead and bring in the scan tool, and I'm going to go to actually it's already loaded here. So let's just quickly talk about what it is. What is the Horner rule? Again, the Horner rule is just one of confirmation. In my case, the way that it's been built is looking for 3 consecutive days above a level that you've deemed to be potential resistance, or to tell you that the trend is continuing. And in some cases, a trader will use the 20-day moving average. That's what we've done here with this one. Now, let me show you how this looks with the edit button here. And for the record, I am going to share this with you all. I'm going to make it available to you both in the archive notes below and in the chat. I'll share it with you. But this is really what we've done is created that. What we're looking for is a stock whose close 3 bars ago went from below the 20-day moving average to above. And then the close 2 days ago was above the 20-day moving average. And then a close from the 1 day ago is above the 20-day moving average. And then today remains above the 20-day moving average. That's all this is. So 3 bars ago, the stock moved from below the 20 to above it, and then above the 20 at the close the next day, above the 20 at the close the next day. Okay. And I'll remind you that while we have defined this using the 20-day, you can take this same script, click edit, and then just start to change everything and say, well, instead of the 20-day, maybe I'll save the 20-day Horner rule scan, and now I'll make a 50-day Horner rule scan. So such that is the action from 3 days ago below the 50 and now above it, and then another day above it with a close, and then day 3 above it with a close. So be aware of that. Don't feel stuck to relying on these details. Take the details and then start to customize them to your liking. Some of you traders don't like the 20-day moving average, and I've spoken with many of you who like the 30-day moving average, a 6-week moving average. That's not uncommon, and you could work with that as well. There is absolutely nothing to say that you have to use the 20-day again, I want to encourage a process. In fact, there's not even anything that says you need to go 3 days closing above a resistance spot or above a moving average to validate it. That's what the Horner rule is defined as. But let me be honest, what really matters is that you have a detailed approach for your confirmation. Okay, that's what matters. Whether it's 3 days, 2 days, 6 days, have that approach. Define it for yourself. Know that it is your approach, not anybody else's. It's yours. It's the one that's going to help you make your decisions. Okay, that's what we're talking about. Okay, so yes, there is a well-defined process for the Horner rule, but that's not the one I'm encouraging. What I'm encouraging is a process. I want you to customize it. Okay, so we've got this list or this scan. Let me save this with you. Share this, excuse me. So I'm going to go to my actions button. I'm going to share the scan. And what I encourage you to do is not just share it not just load it up, but also make sure that you're titling it really easy. So that, and in fact, make it that, right? Horner rule, for example, and make it easy to locate it. Remember, when you launch this in the application, it will open immediately in a separate window for you, okay? So the other thing that I need to tell you all is that while I had this scan built, it is not guaranteed for its accuracy. It's certainly not guaranteed for timing, and it is not an encouragement for use. What I want you to do with it, though, maybe play with some of the criteria. I think you might find some interesting ideas. Now, let's scan in the S&P 500 against these 20 days, and let's see what we find. One of the ones that we've spoken about recently is the Travelers Group. So let's talk about Travelers. And let's see what we're looking at. Okay, why did we populate this one? Well, 3 days ago, we broke the 20-day to the upside. And then each of the next 3 sessions, everybody, have been holding the same 20-day. Now, in this case, Travelers didn't even, not only did it break upward, it didn't give anything back. I mean, you've actually maintained the majority of this move. This is, relatively speaking, nice to see because you've got a broken downtrend and held a major level over the last 3 days. So this one stands out. You can see why this made the list, right? Obviously, 1 day up, hold the close, and then the next, everything since has been above the 20-day. That's intriguing. So that stands out. That's what we're looking for from the so-called Horner rule scan. So gave you some opportunities, gave you some ideas. Again, play with it though. Change your moving averages to the ones that work for you. And in an instance like this, everybody, recognize that the Horner rule scan might be consistently decent at a 20-day when the market is trending that way. But what if in another week we have the S&P residing near the 200-day moving average? Well, then maybe we want to start working with 200-day moving average crossovers, looking for those stocks making a much more significant trend shift in a longer term window of time. So hopefully you all find that to be very helpful. I do love spending time building some of these scans out, everybody. They are fun, especially when they work out, right? Okay, so let me reiterate our process with these scripts. So when you take the script, don't click the link, copy the link, okay? When you copy the link, we come into the setup, open shared item, and then we paste it right here. So just for me, it's Control-C, Control-V. We hit preview. There you go. Okay, and so it's going to import here. This import item as is also your title. So this is where you might change it to say Horner rule, okay? And then once you do, just hit import, and then you can't see it on my other monitor, but it opened it just like this, okay? And so let me remind you, all I've done is to scan this Horner rule process within the S&P 500, but you could certainly pick any other watch list from your public, could be the NASDAQ 100 if you'd like, or maybe you're out there already. Maybe you're watching the Getting Started with Stock Investing class and you've been building a fundamentals heavy list of watch list securities, and you want to utilize that list of 30, 40, 50 fundamentally sound securities that you've deemed to be interesting companies for you, and you're simply waiting for the proper opportunity from a technical standpoint. That's what one of these can do for you, utilizing your personal watch lists as well. So you don't have to scan the entirety of the market. Remember, you can scan your own watch lists. You can scan your own portfolio, right? So this absolutely, I'm hopeful, could be helpful for you all. Now, let's see. I got one more stock. Let's take a quick look at my monitored portfolio, see if we've got any positions, any example positions to take a quick look at. I had put on a recent trade with you all in Bank America that has not come out in the wash. We had a a specific order that we tried to go with. Let's take a look at Bank America just to see what our order was. It hasn't executed for us, but we have an order. There it is. Yeah, we've got a buy order in the midst of everything with subsequent sell strategies here. So we have not executed. It is to buy 100 Bank America as a good till. Okay, we're buying on a stop breakout, 48.5. That's what it is. Yeah, so we're looking to get above 48.50, which is way up there, everybody. So this, when we placed this originally, it was the idea, hey, let's not buy if we don't have a breakout. Thankfully, this has worked out for us, right? Because the move we've made, if we were buyers when we placed the order to be a buy on a close over the breakout, over 48, if we'd have bought thinking a breakout was coming, and instead we get a healthy pullback, boy, this would have been painful to deal with. This is an excellent example, and I'm not patting myself on the back, but an excellent example of why breakouts and buy stops can work and what they can keep you from stepping into, right? If you did it that way, if you bought here thinking the breakout was coming and it didn't materialize, you could have been down as much as 9 or 10% to the lows. Okay, that might have been a difficult 2-week window to sustain that, right? But what we did was, if we closed over 48.5, we would be buyers on that move, and then we would have a sell stop exit order beneath the breakout by a reasonable amount relative to our expectations for what could happen in the form of profit to the upside. So this kept us from making a trade. I'm glad we looked at this one because, yeah, it didn't execute, but it also didn't lose money for us, did it? Because we stuck to the plan and we didn't get the breakout, so we didn't take the trade. That's kind of a cool thing to see here. Let's see. Yes, Ocean Life. The reason that you only see 2 filters is because this filter, this study here, if you click the edit, you're going to see everything. So reminder, you can add multiple conditions here, and it just shows up on this bar as only one. But it's actually, this study here has all 4 of these studies in it. I hope that makes sense for you there, Ocean Life. If you just hit that edit, you should see every piece of those details. All right. See some good questions in here. You're right. Yeah, Ricebird, thanks for letting Ranjit know that that scan tab. If you're working in the paper money, it will not launch there for us, unfortunately. That is my lone disappointment with paper money, is just that the scans aren't as functional. And I'm a big user of scans, so in some instances you might need to be very, very disciplined if you're getting familiar with scans in the live session. One thing that our friend Cameron does, by the way, Cameron May, when he's working with paper money and live, he might put them side by side, but he does a breakdown of the platform such that here in the color scheme, for example, in settings and the display, he makes it, not display, look and feel. So like here, mine is all dark preferences. So maybe the live one is dark and then the paper money is white, so that it gives a very clear delineation between what's a live session and what's not. But he often will work with those side by side, but making it a little easier to manage, make sure that he's not working. When he's in the live money, he's making live trades and he recognizes it. All right, last thing I wanted to share with you all is just a reminder of our calendar today. The reason for this, though, is because we've made some recent changes. So in the live webcast calendar here, let me just bring you back to what it might look like any given period. But when you come to these sessions here, this is a great spot for you all, because if you're coming here for the archives, this is where you'll get your immediate links to anything else that I might have placed in here. You can click right on the YouTube as well, go right to the actual event. But I want to also call out our recent update to the resources, the new Trader Starter Guide. This is an excellent, excellent place for you if you are still or just getting your feet wet here in either Thinkorswim or trading, everybody. If you utilize this as your go-to spot, just work your way down the various videos and articles. It's going to be a key resource for you. We hear all the time, you know, if I just had a list of things that I could go through, a bit more standardized, if you will, then I'd be happy. This is exactly that for you. So consider using this, everybody. Again, you can find this right from the calendar detail here. New starter guide, it's going to appear in any of our sessions here in the notes. So with that, everybody, I am going to wrap it up. You know, we covered quite a bit today, a little bit outside of our norm, but I hope we got some learnings done nonetheless. Shared that scan with you. I'll make sure to get that in the archive. A big thanks to my friend Barb here in chat today. Follow us on X, Barb Armstrong CS and Kevin Horner CS. And if you like today's discussion and content, please hit that thumbs up button for me down below. It'll help us out as we get this into the archive for you all. So with that, I'll wish you all a fantastic Thursday. I look forward to seeing you Friday for Trader Talk ETF Day, Friday morning, bright and early, market open. Have a great Thursday, everybody. I'll see you again real soon.